Hi class, at this time I want to do a treasury stock problem together. Okay, so I am looking at quick study 11-9. No, 11-11. 11-11 on page 510. Okay? Okay, so as you remember from the discussion, treasury stock is when a company buys its own stock back on the market. It's like you would just call up your stockbroker and say, I want to buy, 50 shares of XYZ, and you are XYZ company. Well, why would you do that? Well, there are a couple good reasons. One is that perhaps you have some extra cash and you really shouldn't be expanding right now. And so the best investment you could make is to reduce the number of shares outstanding, which, when you think about it, will make all of your shareholders out there, their stock will go up in value because you are dividing the value of the firm by fewer shares. So there's a psychology to it. Also, maybe you don't want to issue more shares, but you need to keep some available to give as bonuses to employees that you want them to be owners of the firm. So you buy some shares back to keep in treasury stock for that. So there's a lot of strategic reasons. So let's work through this. So on May 3rd, Zerbal Corporation purchased 4,000 shares of its own stock for $36,000 in cash. Okay, so let's just record that. On May 3rd, we purchased. Now, treasury stock is a debit balance account in the equity section. It is a contra account to equity. And we actually write a check and buy these shares out on the market like we were any other investor. Now, what I'm going to do is I'm going to keep T accounts because we have to keep track of where we are with treasury stock because we may get some additional paid-in capital or we may have a loss when we resell the treasury stock if we do that. Okay? So I'm going to go ahead and debit this treasury stock account for $36,000, and then I'm going to make a notation out here that that was 4,000 shares. So I can keep track of that. Okay? Then it says on November 4th, we reissued 850 shares of the treasury stock for $8,500. Aha. That sounds a little tricky because we obviously sold it for a different amount than we paid for it. Okay? So on November 4th, we took in cash. We sold it to somebody else for $8,500. Okay? Now, we always take it out of the treasury stock account at exactly what we put it in at. Okay? Well, what is 36,000 divided by 4,000? Well, it's $9 per share. So I got to take 850 shares out at $9 per share. 850 times 9 works out to be $76.50. So I'm going to take $76.50 out of the treasury stock account, which is 850 shares. This way I can keep track of how many shares I have left in treasury stock. Okay? 850 shares at $9. Well, what's the difference? Well, the difference is that we got more for it than we sold it for. However, we don't call that a gain or a revenue. We keep it all in equity, and we call it paid in capital treasury stock. So it's anything we got above what we paid for the treasury stock, not par. We're not concerned with that anymore at this point. It's what did we get compared to what we paid for it. Okay? Very good.